There is a category of people who are accustomed to choosing the very best, the most expensive, the top-tier options. They have the best business suit, they have the best car, and after all, their desk, their watch, everything is the most exclusive. And it's fine when this happens on a personal, everyday level. You have the money to lead such a luxurious lifestyle. But it is bad when you overpay for exclusivity while being an investor in the stock market or any other market. So today we are going to talk about the company NVIDIA. It is number one among public companies by market capitalization. As of today, August 25th, 2026, its capitalization is around $5.2 trillion. It is number one in the world. It has fantastic financial performance. Gross revenue for the last quarter was $81.6 billion. Operating profit was $53.5 billion. The gross margin is just off the charts. It is 75%. It is fantastic, something one can only dream of. And at the same time, the revenue forecast for the next quarter is $91 billion. In other words, the company is in a magnificent financial position with about $50 billion in free cash and bonds on its balance sheet, while its debt obligations are only $8.5 billion. If everything is so magnificent, then what is the problem? The problem lies in certain financial ratios. For example, the PS ratio is a coefficient that shows the ratio of a company's market capitalization to its gross revenue. And for NVIDIA, it is 20, which means that an investor is paying a full $20 for $1 of annual revenue. Believe me, that is a very, very high amount. Finally, the PE ratio is a coefficient that shows the ratio of the stock price to earnings per share. For NVIDIA, it is 32. This, of course, is not an off-the-charts value, but it is still very high. And that is why it is worth waiting. And finally, Benjamin Graham, you know this person. He wrote the book, The Intelligent Investor. He would not call you an intelligent investor if you were to invest in NVIDIA at the peak of its value, where the stock is right now. Now let's look from the perspective of technical analysis at what prospects are emerging for this stock. We are looking at weekly candles. The stock is currently trading at $212.75, and here is what we will look at. Right here, there was some kind of high. That was back in the distant year of 2023. It corresponded to some RSI high. Then we get a higher high. Pay attention. And a higher, wait, 1 second, that didn't come out right. A higher RSI high. This indicates that it is a strong growth. It is supported by the indicator, and we are seeing continued growth. But here, the RSI is already showing a lower value relative to the previous one. This is a classic divergence that ends in a correction. If you think this correction is small, let's take a tool and see that its size was approximately 36%, 35.5%. That is a lot. That means the stock lost a third of its value. It became 1.5 times cheaper. Now let's look further. We get higher highs with lower RSI highs. This is already a double divergence. Yes, we had one, and it seemed to have played out, but nevertheless, higher stock price highs gave a lower RSI value, and we are getting an even deeper decline, which breaks this low. Yes, that is, we are setting a lower value. Here the drop was already, let's see, from the high to the low, well, approximately 43%. Why are we doing this? In order to examine the current situation. Let's zoom in on the chart and look at it from a close distance. Look, here is one high, here is its RSI value. Here is our second high. The RSI is practically at the same level, just above the 70 level. So this is a horizontal line. It turns out that the RSI highs are going like this, while the price highs are going like this. This is a divergence of the lines, this is also a divergence, and it ends with a fairly flat correction. But even this flat correction brought the stock price down by 22.5%. And what are we observing now? We are observing that the stock has set a new all-time high, while the RSI is once again lower. The second time we didn't update the high here, but something else happened. So, a double divergence pattern already suggests that we should look to go below these current values. This is because this formation and the next are actually one structure that implies a downward unloading, which will likely push the price action once again well below the low that was already established there. It was around $164. Now we remove all these drawings and look at the chart from a close distance in the moment. What do we see? We see that the candle from August 10th updated some local multi-week high. Yes, it wasn't an all-time high, but it was a high for many weeks. At the same time, notice that we seem to have signaled a serious downward movement here. But no, it was bought up, stops were triggered, which were located, well, probably somewhere above this zone. And they showed that the stock is continuing to move upwards. But the previous week of August 17th, it once again updated the multi-week local high and closed with a red body, and it completely engulfed the previous green week, including the shadow. This is a technical reversal to the downside, which has a downside target, and it is located in the area of $197, and that is the minimum target. If we take into account the double divergence that we had, then we can assume that a larger target is actually in the area of the 100-week moving average. That is $166. I have nothing more to add. Well, except perhaps for the fact that I would monitor the RSI value in the area of 30. And when the indicator reaches this point, you can take your profit on the short position here. It doesn't matter what happens afterwards. Right now, the weekly candles point to a decline, at least to the area of $197. Well, and in case of continuation, 167 or perhaps even significantly lower towards the 200-week moving average, which is $112. Let's see what percentage that would be from the all-time high. Well, for example, if 112 is the target, that's a drop of, well, a little more than half. That's absolutely normal. This has happened in the stock market more than once. I want to draw your attention to this. Just like in the review of JP Morgan Chase Bank, which has excellent financial performance, NVIDIA is a hostage to its own success. That is, it is in such good financial shape, first and foremost, that maintaining it is, well, a very, very difficult task. And at some point, the company will begin to stagnate. It won't become unprofitable, but its performance metrics will decline, and investors really don't like that. Not to mention that the entire stock market is in roughly the same position. On NVIDIA's monthly candles, we will also pay attention to divergences, and we will start with the RSI indicator. Look, we have consistently lowering highs. That is, our market looked lower. Here is a lower series, well, on a horizontal plane. But they are clearly not increasing. Lower and even lower. And now let's look at how the price behaved at those moments. Look, here the price was rising, right? The high was lowering and we got a 3-month correction. Then the growth continued. The stock is hitting new all-time highs, but the RSI is already clearly lower, and we are getting an even deeper correction. But I mean from a percentage point of view. That is, here the drop was 56%, and here the drop was already 68%. And right now, look, we got new price highs here, and here. And the RSI is lower, and lower. This indicates that the momentum is running out. In other words, the stock is running out of fuel for growth. It doesn't matter what the reason for this is. The financial indicators are excellent, but the signs of stagnation on the chart are evident. And what can we assume? We can assume a decline. And to where? Right here, the 50-month moving average. The last time the stock was at this average was in October 2022. I'm not talking about any lower levels, but the 50-month one is within the scope of the divergence. Moreover, look, 1, 2, 3, it's already at least a double one. Therefore, this is the minimum target from the perspective of monthly candles. But now let's remove all these divergences and just look at the candles. The structure of the candles tells us the following. It tells us that, first of all, we have support in the area of the $138 level, because the next continuation of growth started from this level. Also, the $123 level acts as an important level for us, and this is also a target range for a decline relative to current prices. Well, let's say that's a drop of 35 to 40%. Moreover, note that the 50-month moving average could reach this zone in just a few months. We are not talking about a massive crash, but this is still a lot. Also, look, the June candle completely engulfed the May candle, which set an all-time high that still holds and signaled a trend reversal on the monthly time frame. That is, although the August candle is currently green, firstly, it failed to break the high, and secondly, with just a few days left until the end of the month, it has only broken through the opening point of the June candle, but has not engulfed it. And this means we are entitled to assume that this was the maximum permissible correction. Plus, we had a divergence. It is present on the chart right now, and we can assume that the stock will go down from here. After all, if you open a short position with 1x leverage, that is, without increasing it to 2x, 5x, or 10x, then I highly doubt that the stock will be able to double in value again to a market cap of $10 trillion just to wipe you out and liquidate your short position. In other words, if you're not greedy, here you go, your deposit, which offers a potential profit of around 40%. On that note, I think I'll wrap up this review. Daily candles can be looked at, but they aren't very indicative. I'm a proponent of using larger time frames in the stock market, and we've already examined those. The next one will also be about US stock market shares. Subscribe to the channel and leave your comments. I'll remind you that we did this review on the QuantFury platform, where you can trade not only the stock market and cryptocurrencies, but also ETFs, indices, the Forex market, and all of this without commissions or any additional fees. See you next time.